the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IRDAI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the major developments in the banking space. I am Ruchika Chitravanshi. In this episode, the cover story is about the withdrawal of the 2000 rupee note and what it means for the banks. In Banker's View today, we have with us MD and CEO of Canara Bank, K. Satyanarayana Raju. Continuing with the big news story around the 2000 rupee note, we will tell you what legal tender is in banking for you. Later, in Expert's Take, our consulting editor Tamal Bandhopadhyay will join us to discuss what is happening in the insurance sector and its regulator IRDAI. At the end of the show, we will tell you the results of the last week's poll and the question for this week. Let us begin. On May 19, the RBI announced the withdrawal of the 2000 rupee note as part of its clean note policy. People have been asked to deposit or exchange these notes in the banks till September 30. What does this mean for the banks? Manojit Saha shines some light.
On Friday, May 19, 2023, the Reserve Bank of India announced that it will withdraw the 2000 rupee note from circulation, citing the clean note policy and lack of use by the public. The 2000 rupee banknote was introduced in November 2016 as part of the demonetization exercise after the then 500 and 1000 rupee notes ceased to be legal tenders. This time, however, the central bank clarified that the 2000 rupee note would continue to be legal tender. The central bank has set a deadline of September 30, 2023 to return the 2000 rupee notes to the bank branches or to the RBI's regional head offices. A person can exchange 20 notes at a time. There is no restriction on deposit though. The decision is likely to have a positive impact on the banks. Deposit mobilization will likely get a boost and banks will not need to raise deposit rates further.
Some bit of deposit accretion picking up, because as these customers go on to the bank and deposit the money and in their bank accounts, you can see some pickup in the deposit growth. But unlike, say, demonetization, which was at a very massive scale, and at that time, those denominations were not legal tenders also. So you had an influx of those deposits into the banking system. So we are not looking at anything at that scale as of now, and the time period is also pretty much elongated. It's like almost a 4-month window. And we are still not clear that after 30th September, will 2000 rupee remain a legal tender or not, because that is still not clarified. And so which is where it will be a mix of some of it getting used in the spending, because someone may choose to rather spend the money, and we can see some pickup in the discretionary spends, therefore, in these months, and the rest will be a function of how much gets exchanged and the balance will get deposited. Though anyhow, we were not expecting banks to now increase deposit rates, because RBI has taken a pause, though they have indicated that it's not a pivot, it's just a temporary pause and they will monitor the situation. But our house view is that we are not looking at any more rate hike, and we have seen some bit of easing on the bond yields. And even therefore, we expect on the deposit side also, the rates have largely peaked. But with this development, you are right. And this will be further one more reason to say that there will not be any more deposit rate hikes from here on.
The total value of 2000 rupee banknotes in circulation has declined from 6.73 trillion rupees at its peak on March 31, 2018 to 3.62 trillion rupees on March 31, 2023. At the end of March 2023, they constituted only 10.8% of the notes in circulation. Bank deposits growth has lagged credit growth since last year. According to the latest RBI data, deposits are growing at 10.4% year-on-year, while credit growth has been 15.5%. Peak deposit rates of most banks are between 7 to 7.5%.
This could also, in fact, lead to higher deposit mobilization for the banks. Last time, if you remember, during demonetization 2016, that time there was a surge of almost 6.9 trillion Indian rupee between November 16 and March 17, right? Which led to almost 400 bips increase in the CASA for the banking sector as a whole, and especially for the PSU banks. This time, even if we see some increase or some surge in the deposits, that could be good for bank because they are anyway facing some tight liquidity situations. Last time, what happened? The NPA recognition, no dispensation given by the RBI was misinterpreted as a repayment holiday, and that led to some spike in the NPA for the sector, especially for NBFC, MFI category. This time we don't expect because economic disruptions as other denomination notes are still in circulation. That is not going to happen. In fact, several of the NBFCs have come out of this and they have reduced the cash collection. So in nutshell, it will not be negative for credit growth, not much impact on the asset quality, but positive on the liability side. So overall, we believe this is net positive for banking sector as a whole.
RBI Governor Shaktikanta Das said the impact of the withdrawal of the 2000 rupee note on the economy would be very marginal. He also said one should not rush to deposit or exchange the notes as there is ample time. RBI has asked banks to provide appropriate infrastructure at the branches, such as shaded waiting space, drinking water facilities, etc., considering the summer season. It has also told banks to record daily data on deposits and exchanges.
As Manojit's report said, this decision is likely to have a positive impact on banks and also give a boost to deposit mobilization. In our next segment, the Managing Director and CEO of Canara Bank, K. Satyanarayana Raju, talks to Manojit Saha about the bank's performance and future outlook. Here's the chat.
Hello and welcome to the Business Standard Banking Show. Canara Bank's standalone net profit jumped 90% during the Jan-March quarter to over 3,000 crore, driven by healthy recovery. Asset quality of the bank improved, while net interest margins expanded, albeit marginally. K. Satyanarayana Raju is the Managing Director and CEO of Canara Bank, is with us today to share the public sector bank's future roadmap. Mr. Raju, welcome to the show.
Thank you, sir. Thank you, Sahasab.
Let us start by asking you that Canara Bank has projected moderation in the credit growth in the current financial year. Is this because of elevated interest rates?
No, actually, the one thing I would like to recall from our earlier guidance to the stakeholders during the last year that we have given a guidance of around 8.5% credit growth last year, and we have achieved around 16.4% in the current financial year globally. Domestically also, we have grown domestic credit more than 15.01%. Whatever we give the guidance is a minimum guidance. It's not that that has been given as a target for that. All the guidelines, whatever guidances we have given various parameters, whether it's a business growth or credit growth or overall it's a minimum guidelines. So even this year, as against the last year 8.5%, this year we are given a credit growth of a 10.5 minimum growth rate. That's a minimum growth rate, sir. But definitely we are confident that we are that at 12 to 14% credit growth will be there. We are not looking at that moderation in the credit growth because there is a demand. There is a demand both sides at the corporate as well as in the RAM sector. So we are expecting a good growth in the RAM. Even a corporate last year we have grown almost to 16 to 17% domestically.
Right.
The fourth quarter the growth is looking at little bit subdued compared to that other 3 quarters. The reason behind that is it's not that there is a moderation in the demand. Actually that the corporate, the organization as an organization, Canara Bank has taken call to grow at par with the RAM growth, since we want to maintain as a whole balance sheet as 45 to 55% a ratio between the corporate and the RAM sector to maintain the margins. Otherwise, there is no depth of business. there is a demand continues both sides in the corporate as well as in the RAM sector.
Now coming to deposit growth now, deposit has grown only by 9% in the FY23, despite the banks offering a special deposit schemes, etc. So what more you can do to beef up the deposit growth, and what is the target for deposit growth in the current financial year?
So if you look at that current financial guidance, sir, the overall growth of a balance sheet we are given at 10%, credit at a minimum 10.5%, but the deposit growth at a minimum 8.5%. So why we have projected a lesser growth rate in the deposit compared to the corporate? It's not that there is a tough task for the growing at the deposit. That's not actually the reality, sir. The reality is our CD ratio earlier, it was 2 years back, was 68%. So that gradually we increased it to now 73%. But in the next 3 years, we want to increase it to 76 to 78%. Because the present CRR and SLR, total together, it is only 22.5%. There is a scope to go CDR up to CD ratio up to 77.5%. That is like using your resources optimally. When the higher rate interest regime, mobilizing and keeping in your books, it will have its own impact on our margins, which we don't want to do. Under the low interest regime, there is a chance for deploying even overnight or in a money market or anywhere. But at the higher interest rate regime, the mobilizing the more than what you require and keeping in your balance sheet as a liquid cash, it will have impact on the margins. That's why we are growing slowly compared to the credit growth. We are growing at a little less than the credit growth. The purpose is to increase our CD ratio.
You were appointed a few months back, I think in the fourth quarter, and you were telling us a 2-3 year roadmap on certain parameters. So have you kind of decided a plan for the next 3 years of the bank under your leadership?
Yes, sir. Actually, recently in the first week of May, our board has met for a strategic business meet. We had a meeting with the board for the 2 days, and it was discussed thoroughly along with the respective business heads and the field functionaries. We involved the circle heads, regional heads, and even the branch heads in that strategic meet. In that strategic meet, we freezed certain parameters for next 1,000 days. It's approximately 3 years. The 3 years roadmap has been fixed. And there we want to continuously grow at average business growth of 12%.
12%.
12%. That's actually the figures what we freeze. More or less, again, we want to achieve our CD ratio around 76 to 77%. That by the 3 years end. And CASA at this moment, it is 33%, which we are aiming in the 3 years. We want to reach at 38%. So that will help us in our NIMs to improve further. And our gross NPA and net NPAs, we want to bring it below 3% gross NPA and net NPA also much below the 1%.
In the 3 years time period.
3 years time. And the return on equity, I want to share at this moment that just 4 days back, the Economist, British columnist, the magazine, has written a column on Indian banks, especially on the government sector banks. The 10 years back, what the loss-making banks have turned around and earning a huge incomes. They have quoted Canara Bank as because the highest growth rate in the net bottom line is the Canara Bank with 87% year on year.
Right.
Bottom line. That he has quoted that, and he also quoted that versus this, the Indian private banks are growing their bottom line at 15 to 25%. And globally, the return on equity, acceptable return on equity is 15%. As against that, this Canara Bank is giving already now more than 19%.
Mr. Raju, thank you very much for speaking to Business Standard. It was a pleasure talking to you, sir.
Thank you, sir. Thank you, sir. Thank you.
And I wish you all the best in the remaining part of your tenure.
Thank you, sir. Thank you so much, sir.
While the 2,000 rupee note has been withdrawn, it continues to be a legal tender, which means you can still use it to sell and purchase items. The withdrawal of this currency note created confusion about this aspect of legal tender, and for the right reasons. Raghu Mohan clears the cobwebs on what this issue is in our Banking for You segment.
The Reserve Bank of India has withdrawn its highest value currency note, Rs 2000, from circulation, adding that the notes will continue to be legal tender. So what is legal tender? Legal tender is a coin or banknote that is legally tenderable for the discharge of debt or obligation. The coins issued by the Government of India under Section 6 of the Coinage Act 2011 shall be legal tender in payment or on the account provided that a coin has not been defaced and has not lost weight, and every banknote issued by the RBI, be it Rs 2, 5, 10, 20, 50, 100, 200, 500 or 2000, unless withdrawn from circulation, shall be legal tender anywhere in India. The printing of notes in the denominations of Rs 2 and 5 has been discontinued, and these denominations have been coinized as the cost of printing and servicing these banknotes was not commensurate with their life. However, such banknotes issued earlier can still be found in circulation, and these banknotes continue to be legal tender. But Rs 500 and Rs 1000 banknotes of the Mahatma Gandhi series issued up to November 8, 2016 have ceased to be legal tender with effect from midnight of November 8, 2016. That is when PM Narendra Modi announced the government policy of demonetization of Rs 500 and 1000 notes. Currency notes are termed legal tender because they are guaranteed by the Government of India, according to the provisions outlined in Section 26 of the RBI Act 1934. Thus, technically legal tender is something that is recognized by laws as a mechanism to settle debt, whether private or public. In India, the RBI has the sole right to issue all banknotes, except Rupee 1, which the Government of India issues on its own. The design, form, and material of banknotes shall be as approved by the Union Government. In consultation with the centre and other stakeholders, the banking regulator estimates the number of banknotes likely to be needed denomination-wise in a year. It then places indent with the various currency printing presses to supply banknotes. In the case of the 2000 rupees currency note, the RBI has said that it wants to withdraw these notes from circulation, even as they continue to be legal tender. What this means is that it would like people who have these notes to deposit them in banks or exchange them for other denomination currencies. However, if anyone wants to pay using these notes, they can legally do so, as these notes continue to have the backing of the Government of India.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. IRDAI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So while many would be lining up to deposit these notes in the banks or buying gold or pay for their food deliveries, I'm sure many would like to keep that one note as a souvenir of the post-demonetization era. In our next segment, Tamal Bandyopadhyay joins us to talk about how the insurance regulator, IRDAI, is revolutionizing the insurance sector. Hi Tamal, welcome to the Business Standards Banking Show. We are discussing today inclusive insurance and how the insurance penetration in India is increasing. However, you've said in your column that after 2 decades of privatization, insurance is still a sunrise industry. How do you see this changing going forward?
Yeah, this is changing. We have about 4.2% in insurance penetration. This is the 10th largest market. And among the BRICS nations, India is the second, has the second highest insurance covers out of after South Africa. Now, but we shouldn't get excited about that because we are still, if you look at our per capita income and almost non-existent social security. So we need more insurance cover. We need more and more people coming under that. And fortunately, the new IRDA, it's no more new, it's more than a year old. This gentleman has been doing a fantastic job, the regulator. He is changing everything. I mean, just to give you one example is this: earlier for launching a new product, so much time was taken because insurance company would file the product with IRDAI, and the regulator will take its own time from between filing and approval, which was an enormous time was taken, and so that it was killing innovations. And now from there, IRDAI first shifted to file and use, meaning you don't have to wait for the approval. You can just continue to use the product immediately after filing it. And now it says, don't even file. You start introducing your products. Of course, IRDAI will keep an eye on what you are doing. And if something is wrong, IRDAI will pull you up.
Do you see any similarities between the way banking and insurance regulators are now approaching their sector?
Yes, too many actually. If you see, insurance is part of the larger financial system. And on the one hand, you need to have more and more people under the insurance cover. And on the other hand, if that happens, what will happen? The pool of long-term money actually gets gets bigger, and that would help us to actually address the problem what we have from infrastructure financing, even for say Government of India bond, which insurance companies are buying. But once you have the large pool, the burden from the banker's shoulder would be off, both for infrastructure financing or for any other long-term need. And there are many similarities. I just like to mention one of them. Like in bank, you have SLBC, that's the State Level Bankers Committee, where there's a lead bank, and that particular bank, which is a leader bank in one particular state, takes care of how the credit flow should happen to the underprivileged segment. Similarly, now the insurance segment is saying that, look, each of the insurance company need to be associated with one state government and take it forward. So they have involved the state governments in the spread of education. So it's a very similar thing which the Reserve Bank of India done for the financial sector, for the banking sector. Now the IRDAI is doing that. And remember, IRDAI is the acronym, but development is part of it. Now, neither SEBI nor RBI has this development mandate. IRDAI has the development mandate, like the Pension Regulatory Authority also. And this new IRDAI chief, which is, again, I'm repeating, not new, more than 1 year old, is taking the development mandate very seriously. And I'm saying in a positive sense.
How will IRDAI achieve these twin objectives of achieving insurance for all and the ease of doing business?
So there are changes both in mission and vision. I mean, it has to be, as I said, development is the main agenda. It's insurance for all, and to ensure that everything that's to be done, it's been doing. For instance, from rule-based regulation, it has gone to principle-based regulation, which means no micromanagement. It's left to you. It's left to the insurer. I mean, of course, you can't exploit the insurance buyers. You can't missell stuff. It's keeping a hawk eye. But overall, it's a principle-based regulations. No more micromanagement. That's one structural part when it comes to regulations. The cost of compliance is going down. Now, on the other hand, if you see how to spread, now it's talking about, apart from introducing newer products and going for a huge coverage, now you're talking about one platform called Bima Sugam. Now, Bima Sugam is for smooth and efficient servicing and selling of insurance, claim settlement and selling of insurance product. And along with Bima Sugam is also attaching the two more platforms. One is called Bima Bahak and another is called Bima Vistar. Now, all this, if you combine all the three, in the rural India, particularly in the Northeast, where the insurance coverage is minuscule, you will find people, and technology is making it possible. It's doing that. Now, there have been talks that, look, I mean, you are taking care of only the people, the insurance buyer. What about the distributors? No, the distributors can work as an intermediary even on this platform. So it's not that distributors are no more there.
Well, insurance does seem to be a very happening sector right now. A lot of interesting things that IRDAI is doing, bringing down the cost of compliance, following a rule-based principle, not principle-based regulation instead of rule-based, as you said. And ultimately also involving state governments in reducing the burden on banking system. We have to watch out for the draft insurance bill and what it holds for the sector's future. Thank you so much, Tamal, for joining us today, and we'll see you again next week. As Tamal said, IRDAI is taking the developed mandate very seriously, and rightly so. Last week we asked you, is the Indian banking system safe from the global contagion? 71% of our respondents said yes and 29% said no. Continuing with our theme of the 2000 rupee note now in withdrawal mode, we are asking you this week, is it a good decision to withdraw the 2000 rupee note? Our polls open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. IRDAI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.